Hello everyone. This is Mariko with Real & Associates at John L. Scott. And today I am very grateful to have Brandon take time out of his day. Brandon is a lender at Dwell Mortgage and a great friend of mine to help me go over some common questions that people ask me, and it might be things that you might also be wondering about. So let's go into interviewing Brandon with some of these questions.
How do you determine your budget?
From my point of view on the mortgage financing side, I'm much more concerned with affordability for a client than I am with what their budget is. I think that those two can also align, and that's where it's important to kind of come together and strategize together to figure out, hey, this is kind of where you guys are comfortable at, because you have your own personal set of budget or budgets, right? This is what your income and your current financial picture can support from an affordability perspective when you're going to qualify for a home loan. So I guess what I'm saying, Mariko, is it's important to have that dialogue and find out where the budget and that affordability piece intersect. Because I think that's where you really find your success with the home perspective or the lender's perspective. They rarely want to see a borrower over leveraged on their expenses. So they want to kind of try and cap that debt to income at 50%. They don't want more than 50% of your income dedicated to monthly debt payments. And that could be for your auto loan, for your credit cards, for your student loans, and your housing payment. What I would tell people is if you're just trying to do easy math to figure out how much of a mortgage payment you could qualify for, I've got tools available that can get pretty specific, and I can share those links with the video later on, or Mariko can send those out. But the quick rule of thumb is you take your monthly gross income. Everything in the mortgage world is calculated on a monthly basis because you make your mortgage payment on a monthly basis, right? So you take your monthly gross income, take half of that, because remember we talked about that 50% debt to income. Take half of your monthly gross income and subtract out all of your current. What?
And that's before taxes or deductions.
Yeah, gross is before taxes. And the reason why it's done that way is because everybody is in a slightly different tax situation, right? And so to create a level playing field and make it a fair game, everything is treated before tax on the income side. So take half of your gross monthly income, subtract all your monthly debt payments, whether that's 2 credit cards, a car loan, 3 student loans, just subtract all those monthly payments out of that number. And whatever is left is how much mortgage payment or housing payment your income can support. So easy math, if you have a gross income of $10,000 a month, $5,000 of that income can be used for debt. Let's say you have $2,000 of other debt payments that you make. Subtract that out of that $5,000, you're left with $3,000 a month that you can then use for a house payment.
How much should your down payment be?
And what I usually ask my clients is, what monthly payment are you comfortable making every month on your house? Because then we can kind of reverse engineer the math. So if you tell me, hey, Brandon, I really don't want my house payment to be more than $2,000 a month. I'm like, great, we have a target. That's what we're shooting for. But then in the same sentence, you tell me I'm looking at a $500,000 home. Now what I need to do is figure out how much down payment will get us to that goal monthly payment of $2,000 a month, assuming that you're buying a home for $500,000. So that's kind of how I approach that question is, what's your target monthly payment? How do we get there with the down payment? Now, like you said, Mariko, most new to the workforce people who are looking at buying a home will not have 20% saved up yet on their own or homes in our market, right? And we're talking specifically about Snohomish County, King County, Pierce County. These are real estate markets where housing and home prices have appreciated significantly over the last decade, right? So it's hard to expect someone who's just started their job to have, I believe the median home price in King County right now is $630,000. That's just the median, right? You know, most homes are probably more than that. At least half of the homes in the market are more than that. The other half are less than that. So at a $630,000 purchase price, we're talking about a $126,000 down payment if you want to get to 20%. Correct me if I'm wrong, like I still remember my 20s, but I don't think I ever had $126,000 in the bank during my 20s. Never got to that, but it's really hard to, because that's essentially a full annual salary saved in your bank account. How do you live if you're saving every penny you make, right? So So that's where the different options available when it comes to down payments really play a huge key role to helping, especially first-time home buyers, get into a home, because you can't start building equity and you can't start building wealth through real estate until you get into your first home. And then you can leverage all of the benefits of being a homeowner, like property appreciation, amortization gain, all of those things that help you build wealth through equity until you just can't get to that point until you get into your first house, right? So the common myth or misconception is that I need to wait until I have 20% saved up to purchase a home. I think 20% is certainly a goal that you can have. I just think it's not necessarily a realistic goal. You can get into a home as a first-time home buyer in most cases with as little as 3 to 5% down. And we'll probably touch on this here maybe in another segment, but there's also home purchase programs available with as little as 0% down. So there's options for lower down payments. And I think the way that those have to be viewed is it's a key to get into the door of home ownership, right? As soon as you can get into the door of home ownership and start building equity, you're winning, I think.
What is PMI? Why is there PMI? Is PMI a bad thing? How much is PMI? And how can you get rid of PMI?
Private mortgage insurance is the mortgage insurance attached to conventional loans when you're putting less than 20% down. And just like any other insurance policy, whether it's health insurance or auto insurance or all the different types of insurances that are out there, it's based on risk. The pricing for mortgage insurance is based on risk. The example I always use is with auto insurance. If you're a risky driver, meaning you've been in several accidents, you have a bunch of speeding tickets, and maybe you have a DUI or two, your auto insurance, you could expect it to be pretty dang expensive, right? Maybe even $1,000 or more a month, because you're a risky driver, and the company that's insuring you looks at you as having a larger or greater likelihood to be involved in an incident, right? That they're going to have to pay for. So that it's the same way with private mortgage insurance on a mortgage. The more risk that's present in the transaction, and risk can be present in many different ways in a mortgage transaction. It can be present in you putting significantly less than 20% down. It can be present in you have a credit score maybe that's not so good or needs some work, right? Less than stellar credit. It could also be present in you're qualifying for a home purchase at the very tip-top end of your affordability range, right? You're close to that 50% number that we talked about. So you're a little bit more of a risk, because the way the lender or the bank looks at it is, what's the chance of this person stopping their mortgage payments? What's the chance of them defaulting, is the official term, defaulting on their loan or walking away from their mortgage? The more risk variables that are present there means it's an increased likelihood that the default could happen. So they're going to charge more for the mortgage insurance piece. It's as simple as that. As to home ownership, like if you're putting less than 20% down on your home purchase, you're going to have mortgage insurance in some way, shape, or form. All mortgage insurance is a tool to allow you access to a home purchase scenario without having to have a bunch of money, right? And for most people, like we touched on earlier, the reality is we're not going to have that 20% down payment right out of the gate. It's going to take either a lot of saving or selling a home that you purchased with less than 20% down to get the 20% for your next home. The average down payment was like 7 or 8%.
I remember you saying that last time.
So, I mean, that leads me to believe that most people buying homes aren't putting 20% down. So what I would say about mortgage insurance, it stinks. There's an extra cost to owning a home when you have less than 20% down. But I look at it more as a tool.
On average, how much is private mortgage insurance?
I would say if you're putting, it's highly dependent on credit score and the amount of down payment that you're putting down. If you're doing the minimum down payment on a conventional loan, which would be 3% for first-time home buyers, and your credit score is good, I'd expect your mortgage insurance to be a couple $100s a month. More and more down, let's say you put 5% down, maybe your mortgage insurance is only $150 a month. As you put 15% down or 10% down, maybe it's closer to 120, and it just goes down as you get closer to that 20% mark. Same thing with credit score. If you have a credit score that's like 640, your mortgage insurance is going to be probably several $100s or more a month, $300 to $400, it depends. But as your score gets closer and closer to 740, the mortgage insurance gets cheaper and cheaper.
How do you get rid of private mortgage insurance?
government loans like an FHA loan or a USDA loan. VA loans don't have mortgage insurance. It's a different type of loan program, but FHA and USDA loans do have mortgage insurance. And those aren't private companies providing that mortgage insurance. Typically, they're government entities that are insuring the property. On a conventional loan, about a $500,000 home, whenever you did, you paid $500,000 for it. Let's say your original loan amount was $480,000. You only put $20,000 down, right? You're gonna have mortgage insurance. As soon as your loan balance gets to $400,000, that's 80% of $500,000, you're eligible to have your mortgage insurance removed, okay? And that's one way to do it, and that's a way a lot of people do it. There's another way to do it, which is through a refinance. When you refinance your mortgage, you can take advantage of property appreciation because you don't have to go off of the original value or the original purchase price of the home. You can go off of the market value. So that $500,000 home that you bought 3 or 4 years ago in today's market might be worth $650,000, right? $625,000, $650,000. So you have a lot greater chance to get to that 80% mark if you can take advantage of appreciation. So that's private mortgage insurance and how you get rid of it on the conventional loan side.
Let's look into a scenario where you wait until you have 20% saved up before thinking of buying a home, only because you don't want to pay PMI.
So this is one thing I wanted to show you. This is what I call a real estate report card, and this is specific to King County. There's a lot of data on here, and it's a lot of good data, good information, but this is kind of what I was alluding to earlier. The median home price in King County is $628,450. And I like to look at the appreciation and my 5-year gain over time. So if I bought this house for $628,450, I can expect in year one, I don't know if you can see it, it's kind of small, but in year one, that same house is gonna be worth $664,000. At the end of 5 years, it's expected that home be worth $808,000. So 5 years from now. So you're really, to put a number on the value of appreciation, over 5 years, you can expect to gain almost $180,000 in value on your home, which translates directly to equity. Because as that home goes up in value, the equity in your property or in your home also increases at the same rate. So I wanted to show that, and then I'm gonna show you something else here. Let me go over to this cost of waiting. I like the cost of waiting stuff because here's the question that we get all the time, right? Should I buy a house today? I only have 5% that I can put down, or should I wait to save up that 20%? So what I would tell you is it's going to be a lot harder than it sounds to make that gap up of having 5% down today to having 20% down 2 years from now. It's a lot of money to save, right? So what are you missing out on is kind of what I want to focus on when you wait to purchase a home because you want to save more money to purchase that home. So what we're looking at here is a cost of waiting breakdown. So I've got, if you get a loan today, and this scenario here is for a $650,000 home today. In today's market, which isn't that far-fetched, right, Mariko? You see $650,000 homes all over the place, right?
Yeah, depends on the area.
Yeah, it's a pretty common price point. So if this home is $650,000 and you have, for this scenario, I'm using 10% down. Let's say you have 10% available for your down payment, which would be $65,000. Your loan amount on that $650,000 home is going to be $585,000. We're assuming that today's market rates, which are historically low, are going to stay the same for the next 2 years, which I think is probably not that safe of an assumption. I think interest rates, if they're not the same, they're going to certainly be higher 2 years from now. But for the purposes of this scenario, we're just going to act like the market's not even going to change over the next 2 years. The interest rates are going to remain at historical lows, okay? So 2.75%. You're going to have mortgage insurance. You're putting 10% down, not 20. So your mortgage insurance is $137 a month on this home purchase, right? Fast forward a year from now you've saved an additional 5%. Now you have 15% that you can put down on a home purchase. And this is the exact same home that you were looking at a year ago, okay? That home a year ago was $650,000. In King County, it's projected that same $650,000 home last year is now going to cost you almost $687,000 based solely on appreciation, okay? So that home is, for all intents and purposes, $37,000 more expensive 12 months from now. So even though I have 5% more available because I saved for my down payment, I'm now spending $37,000 more for that home, right? So I'm going to keep my interest rate the same and yada, yada, yada. Now that I have 15% down, my mortgage insurance went down below $100 a month. It's only $95 a month now. Now, what if I wait 2 years, Mariko? Because I think within the next 2 years, I can have 20% down for my down payment. Super. I pass on that $650,000 house today because I want to wait 2 years and put 20% down. That same $650,000 home 2 years from now is now $723,000, right? So you can see what I really want to focus on here is the loan amount, because that's all that really matters. Is the loan amount changing? And you'll notice buying my house today, my loan amount's $585. If I wait a year from now and save up another 5%, my loan amount's almost the same, right? Because even though I'm putting 5% more down, now my house is $37,000 more expensive. So my loan amount's going to stay about the same. And then if I wait to put 20% down, my loan amount's still kind of right within that window. It's not like I'm borrowing a lot less because I waited to save 20%. I'm still borrowing about $579,000. The benefit here is now I don't have mortgage insurance, right? Zero. So
what is the true cost of waiting?
So what I wanted to focus on, given all those numbers, and you might have to watch that 10 times to catch everything because there's a lot there, is the true cost of waiting. Because when you wait to buy a home, you're missing out on two things. The first thing you're missing out on is amortization gain. It's a super powerful term because everybody always wants to talk about appreciation, which I think is cool. Properties appreciate in value. When you have a mortgage and you make your monthly mortgage payment each month, a portion of that payment goes to your principal balance due on the loan. The other part of it goes towards your interest, right? What most people don't realize is that portion of their payment that goes towards the principal balance of their loan is like putting that money in a savings account. Because what you do when you pay down your loan balance is you own more of the home now, right? So you have more equity in the home. So when you go to sell that house, you get that money back, plus whatever value it's appreciated. So it's literally your home is a savings account, and that portion of your payment that you make every month that goes towards principal is a forced savings plan. You're saving money in yourself, you're investing in your home, and you now own more of that home. So given that definition of amortization gain, this is what you're losing if you wait a year. You're losing out on $12,731 given the scenarios that we outlined on that previous screen in just amortization gain. Because if you buy a house today, rather than wait for a year from now, you're missing out on 12 monthly payments that you could be making and paying down the balance of your home, right? That number for this scenario equates to almost $13,000 that you're losing just because you're not making a mortgage payment, okay? The other half of the equation is appreciation that you're going to miss out on because you don't own the home. You see that okay, or is it small?
Yeah, I can see it.
You can see it? So you're missing out on almost $37,000. We saw this on the previous screen in appreciation in King County. Those two numbers together equate to about $50,000 in lost money for you as a home buyer because you decided to wait for a year so you could save another 5%. Fast forward to the 2-year option and it doubles. You're almost missing out on $100,000 because now you've missed out on 24 mortgage payments that you could have been making on that house and 2 years of appreciation at $73,000. So you're leaving $100,000 on the table just because you didn't want to pay mortgage insurance in most cases. So when I look at the cost of mortgage insurance, and in most cases, without a bunch of like additional layers of risk, like poor credit and things like that, mortgage insurance is a huge tool. Like, wouldn't you rather, Mariko, pay $137 a month for the next 2 years so that you could be $100,000 ahead? I mean, if I even did the simple math on that, I'm just pulling my calculator up here. If I pay $137 for 2 years, that's 24 payments. That's a total of $3,200 in cost to gain $100,000. I don't know any investor from San Francisco to New York that's not going to pay $3,000 to gain 100. It's a great bet on yourself, right? And that's obviously operating under the key assumption that the real estate market continues to appreciate and all of those things, which quicker path to wealth than through real estate, in my opinion.
Can you get a loan if you want to buy with your partner but aren't married? And what if one of you has bad credit?
it doesn't really work any differently. I mean, anybody can buy a house together. I mean, there's no real rules around like, hey, like I couldn't buy it. Saying, what if I'm in a situation where it's me and my like fiance, and I don't have really good credit, but she's got a 780 or an 800. Is that going to be detrimental to us on the loan? So what I would tell you is there's three things that are evaluated during a pre-approval and during the qualification for a mortgage, and it's credit, income, and assets, because those are going to be the things that determine ultimately if you qualify for the mortgage. So if you have bad credit, but you make the majority of the income for the relationship, chances are you're probably going to have to be on the mortgage, because we need to qualify you with that income that you're earning to be able to support the mortgage payment, right? Sometimes you'll get yourself into a situation where your significant other is maybe like a stay-at-home mom or a stay-at-home dad or whatever the case may be. They don't work and they have bad credit. In those scenarios, I usually tell people, hey, if we don't need the significant other on the loan to help qualify for the payment, let's just leave them off. They can go on title, right? You can always go on title with somebody, but they don't have to be on the loan and be legally obligated to the debt, because if we do that, then we can take advantage of the fact that you have the 740 credit score and you make the money for the household, and you don't have a lot of debt or bad credit history. So it'd be easier and cleaner, and you'd qualify for better terms, better interest rate, better mortgage insurance. You know, the list goes on and on if we just do the loan just in your name. So it all comes down to qualifying. So if you're not married yet, it's not going to change a whole lot.
What about if you are married? Does anything change?
The only time when things change a little bit is because of the fact that Washington State's a community property state. If your spouse, so in this case you're married, if your spouse isn't on the loan and it's a government loan, like an FHA, VA, or USDA loan like we were talking about, we still have to calculate your spouse's debts and qualify you with those debts, because the way it's viewed is because of the fact it's a community property state, you're still responsible for your spouse's debts even if she's not on the loan, right? It's shared assets and shared debts in a community property state. So that's something to be aware of. If you're looking at an FHA loan and you're only going to do it in your name and not have your wife on the loan, you're still going to have to calculate her debts, and they're going to have to count as part of your debt to income ratio.
What if your partner has bad credit?
Significant other, or your partner, or your brother, or your sister, or whoever you're buying a home with has less than stellar credit, or has a bankruptcy or a foreclosure, or whatever the case.
Maybe they've just never established credit before.
Or no credit history, which happens too, right? So the no credit history one, you can still qualify for a mortgage without a credit history as long as you're on the loan with a borrower that has a credit history.
Okay.
And that's more applicable to conventional loans than it is to government loans. But the rule of thumb is, as long as that person that has the credit score is the primary wage earner in the family or in the relationship or whatever the case is, you can still be on the loan with them. You don't need to have a credit score.
How can you establish a credit score?
Now, there's a lot of ways to get a credit score. You can do, if you have time to plan, you can get one the right way, which is establishing credit, right? Whether that's opening a secured credit card, using it, opening a regular credit card, using it, building up that history, showing that you have the ability to make the payments. If you don't have time to do that, you can get what's called a non-traditional credit report too, which is a little bit out of the box and not applicable in all scenarios, but you can basically create a credit score for yourself by showing that you've paid your utility bills on time, or your cell phone bill, or whatever the case may be. These aren't bills that traditionally report to Experian, Equifax, and TransUnion, but they're still bills that you pay. So we can show that you have the ability to regularly make payments on the bills that are due, right? So that's one option that you can do. Circling back to what you were saying.
Are first-time homebuyer loans worth it? And do they have a higher interest rate?
I think anytime it makes it possible for somebody to qualify for a home that they otherwise couldn't qualify for, I think it's worth it. It goes back to what we were talking about earlier, not missing out on the gains that you can realize in the real estate market. Like if it is only possible for you to buy a home by utilizing one of the 0% down loan programs, the no down payment options, or the down payment assistance, I think that it's a good tool to get to the point of home ownership. Are those the best loan programs out there? Certainly not. I think it's always better when you have your own down payment and you qualify for your mortgage with your own money, right? You're always going to get better terms when you're putting your own skin in the game, to use that saying, right? You're still going to have probably a higher interest rate on some of those loan programs because, again, there's layers of risk there. You're not putting any funds into the transaction by way of a down payment. So they have to compensate for that somehow. The lender has to look at that and go, okay, if we're going to loan this person money and they're not going to put anything down, how do we make up our money, for taking this risk? And you're going to see that in the form of usually higher interest rate pricing or more expensive mortgage insurance or additional fees or costs somewhere. So,
How much extra does it cost?
well, I think the Washington State has a great down payment assistance program, and you're borrowing the down payment. It's not like they're giving you free money. So you're gonna have to repay that either when you go to sell the home or refinance that mortgage down the road. But what I've noticed is typically across the board, their interest rates are probably about 0.5% to 1% higher than you would find in the regular market if you had your own down payment.